Global markets opened the week caught between softer U.S. rate expectations and a renewed geopolitical risk premium. Friday's payrolls report showed the U.S. economy unexpectedly lost 23,000 jobs in July, sharply reducing expectations for a September Federal Reserve rate hike. That helped the S&P 500 close at a record high, with the Nasdaq leading as technology and semiconductor shares drove Wall Street's strongest weekly advance since April. The immediate focus is once again now on the Middle East. There is no clear agreement to restore normal shipping through the Strait of Hormuz, while Iran has reiterated demands for sanctions relief and an end to the naval blockade and a halt to military action. Reports of an Iranian missile strike on an ADNOC-linked vessel and a Houthi drone attack on a Saudi refinery have raised the risk of the conflict broadening into a second front. President Trump appears reluctant to resume direct strikes, but the preference for sustained economic pressure also suggests that a near-term breakthrough remains unlikely. In FX, the dollar has recovered modestly from a two-month low as higher oil prices and defensive positioning offset the dovish implications of U.S. payrolls. Euro-dollar is holding near 15.50 and sterling around 135, while the commodity currencies are slightly softer. The yen remains under pressure near the 158 area, despite the Bank of Japan's July summary revealing growing concerns over inflation and some support for a faster pace of rate hikes. The Australian dollar is also cautious ahead of Tuesday's RBA decision, where policymakers are widely expected to leave rates unchanged. Overall, the market remains constructive on risk following Friday's jobs-driven rally, but the optimism is being tested by rising oil prices or the pressure for that. Attention now turns to U.S. CPI and retail sales, which will determine whether weaker employment is enough to keep the Fed on hold or whether renewed energy inflation revives the tightening debate. That's all for now.